All right, why don't we go ahead and get this thing going? So thank you very much for joining. We're going to talk about and go through hello, Ben, who just sent a chat. But we're going to talk about an end of financial year checklist that people can go through. This is obviously a popular time of year for people to take a step back and look at their finances. And obviously with the end of the tax year coming up at the end of this month, it's a good time to go through that process. But before we get started, anything you hear today is general advice. I obviously don't know anything about you. I can't offer personal advice, but would be great to have some participation and questions. So if you do have any questions today, just send them through. You can put them in the chat. You can put them in the Q&A, and I'll periodically go through some of them as we're going through the webinar tonight, and then I'll save some time, hopefully at the end, to do that as well. All right, so as I said, we're going to talk about an end of financial year checklist, and we're going to go through 4 main items today. And for people that have been tuning into some of the more detailed webinars that we did across this month, we looked at some of these topics a little more holistically. If anyone wants a copy of those, just send me an email, or any other questions you have. My email address is mark.lamonica1@morningstar.com. Should be in your Zoom invite. But we're going to go through 4 different things that I think are a good thing to periodically do. And I think in financial year, especially when we get into some of the needed adjustments or potential adjustments in your portfolio, it's a good time to do that as well. So we're going to talk about just a review of your overall financial position and circumstances. We'll specifically talk about super. So that's obviously an implication of extra contributions you might want to make super before the end of financial year. We'll talk about reviewing your portfolio and sort of what that means and what type of approach you should take for that. And then we'll talk about any adjustments that you need to make. So obviously this is a time where a lot of people look at rebalancing. So we'll talk about that. And we'll talk a little bit about tax management. So once again, looking at that June 30 deadline for the taxes you will file this year, or this calendar year. All right, so why don't we jump into your overall position and circumstances? At the end of the day, investing is very personal. We all have different goals. We all have different situations that dictate how we invest, and what type of strategy and approach is right for us. So it is worthwhile sitting down periodically and thinking about if your circumstances have changed. So what that's going to do is that is going to influence, of course, all the other things that you may want to do with your portfolio. And, we'll start with goals, and we'll spend some time talking about goals specifically in a second. But, we are big advocates at Morningstar. I'm a big advocate for defining your goals. So, of course, if you do not know where you're trying to get, it makes it very hard to figure out how you're going to get there. And goals, of course, are unique to all of us. And what that's going to do is that's going to give us, obviously, this hopeful endpoint that we want to get to, and we can work our way back on how to get there. Now, goals change over your life, and they change just by different expectations you may have. They change based on your circumstances. So it is important to go back if you have defined those goals, and we'll talk about if you haven't, now's a good time to come up with them. It's always a good time to come up with them. But if your circumstances have changed, your goal potentially has changed. So we encourage people to document their goals and to provide a little detail around those goals. And so now's a good time to go revisit those. Are they still applicable? Are they still things you want to do? Are they still realistic? So we'll talk about that in a second, but sit down, think a little bit about your goals, see if they've changed, because that could change your entire investment approach and strategy. Have there been significant changes to your financial situation? So particularly in times like this, where we're starting to see, obviously, a little bit of a slowdown economically, globally, and it seems like in Australia as well. But how has your personal financial situation changed? Obviously, you could have gotten an inheritance, potentially. Your job status could have changed. All things that potentially change your salary that will have inputs into what you're trying to achieve and how you can achieve that. Your life in general is obviously going to inform your finances. So we all have different circumstances, and those circumstances dictate what we want to do and also how we can do it. So once again, thinking about, and I guess, it doesn't take a lot of time to figure out if you become a parent, or if you are now moving on to caring for older relatives, but thinking about what those implications are and how that might impact your goals. Good time to do that. And, this really ties in, I think, with the 2 bullet points above, but have there been changes to how much you can save and invest? So when we talk about goals on the next slide, a huge input into number one, if your goal is achievable and what a realistic goal is how much you can save and invest over your lifetime. And obviously we can have different timelines based on how far away that goal is, potentially how old we are if we're thinking about retirement. But have either of these things, either if your financial situation has changed for the better, perhaps it's an opportunity to increase your savings rate. If it is change for the worse, or you have more dependence, then potentially you can save less. It's good to look at those implications. And then finally, I always put this one, and I think people roll their eyes when we talk about emergency funds, but emergency funds are really critical for any investor. And they're critical basically because we want to take a long-term approach to investing. And that means we don't want something that happens to us unexpected to mean you're going out there and selling at times where, number one, you don't want to sell and may not be a very opportune time to sell. And the thing I would say about an emergency fund, and there's all sorts of different viewpoints of kind of how big those are, but one thing I would say is we have experienced a lot of inflation. That means your costs have probably gone up. That might mean you want to put more into your emergency fund. And certainly, if there has been changes in your personal or financial situation, that might be a good time to revisit that emergency fund as well. So although that's boring, although it's sitting in cash, it's really what protects us and allows us to compound our wealth that's not in the emergency fund that we get to invest over time, having that safety net there. So good time for that. All right, let's quickly talk about goals. And if you haven't defined your goal, then maybe this is a good time to do it. And I'm not going to spend that much time on this because we have a bunch of webinars that if you want to see, send me an email around goals-based portfolio construction. But when we talk about defining your goals, we want to get really, really specific about that. And what that means is we want 4 different things. How much will your goal cost? Remember, this is an estimate, but still worthwhile putting down. It can be an estimate if you have a very long time till retirement, perhaps. But estimate how much you need for retirement, if that's the goal that we're talking about. And I just wrote an article last week going through the steps of doing that. When do you want to achieve your goal? So this is really important in investing because time is a big factor in terms of growing your wealth. How much have you saved? This obviously is going to change all the time. So this is based on, if you do have a lot invested, it's based on market movements at the end of the day. So good time to revisit that. And then how much can you save in the future for your goal? So what we talked about on that previous slide, where we are assessing if we can save more, potentially save less because we have had a lot of inflation, personal circumstances change, but another really important input. And the reason we're doing this, the reason we're coming up with these 4 different, and we'll cover this a little bit later, reason we're trying to estimate at the very least these 4 areas of a goal is because it allows us to calculate the return we need to achieve that. And that's going to tell you a lot of things about whether that goal is realistic. If you need a 30% return every year, well, maybe you're a lot better investor than I am, but you're probably not going to get that. So that's really where we want to inject some realism into those goals. And if you already have defined your goals, now is a good time when we're talking about revisiting your goals, going through and just looking at what do we have for each one of these. Obviously, your timeline is going to change. The amount of money you have dedicated towards that goal is going to change. But also just looking at maybe you have a different goal. Maybe things have changed there in terms of how much you need to actually achieve it. Really good time to do that. And then we always put this little warning down at the bottom or somewhere every time we talk about goals. A lot of people don't define goals because they figure they can't come up with them. If you have a long timeline to retirement, how are you supposed to know what your life is going to be like? It's okay for your goals to change, and they will change. And that's why we go through these periodic reviews. So you can adjust them, but understanding where you stand makes it a little easier to adjust because you're actually doing that with some sort of starting point. So something that's important to remember. So let's talk about super. So a goal that almost everyone has is retirement. And there's some very specific reasons we do want to look at super. So if you're going through that goal setting exercise and realizing potentially you're a little bit behind where you want to be for retirement, then you can potentially put more money into super. So if we are behind a goal, remember, we look at all those inputs that we came up with on that previous page where we're trying to calculate that required rate of return. There are several things that are going to adjust how much money, that are going to impact how much money you have in the future. And one, of course, is the returns that your portfolio gets. So if you're falling behind, potentially it's a good time to go revisit your asset allocation. Remember that more growth assets like shares, for example, will have higher expected returns over the long run. So if you do have a longer time horizon and you're falling behind your goal, perhaps you can tweak it a little bit by allocating more of your portfolio into growth assets, less into defensive assets. Of course, time plays a huge factor. So when we're talking about retirement, talking about super, delaying your retirement obviously gives your money more time to grow. And then, of course, increasing your savings. So that's what we're going to talk about in terms of topping up super. So just to get the rules down here, because I do think that there's a lot of confusion out there about some of the different rules. So if you're under 65 years old, you can make additional contributions to reach the concessional cap at $27,500. So if you are not putting in that much money with your mandatory super contributions, then there is an opportunity to increase that money. And of course, you can bring forward previous unused concessional caps for 5 years if your balance is below $500,000. So that does, on a concessional basis, that does allow us to increase the amount we're putting in. So when we say concessional cap, what we're talking about is the lower amount of tax that you pay for putting money into super. So at 15% rather than what your marginal tax rate is, which for a lot of people is higher. The other thing you can do, of course, is you can make non-concessional contributions. And so basically a non-concessional contribution means you do not get that tax benefit when you're putting money into super. So you can't get that 15% tax when you're putting into super. You'll pay your marginal tax rate, but your money is then in a tax advantaged account. And so, of course, any capital gains that you have during your working life, any capital gains you have, any income you receive, dividends, interest, etc., will get taxed at a lower rate than your marginal tax rate. So it's a good opportunity to do that. And what you can see here is basically these non-concessional caps are based on the balance of your super. So it is an opportunity to get more money in. And what you can see here is that you can put $110,000 in, but you can, once again, put a lump sum in if you want to use multiple years allocations at once. So this is what you want to look at, obviously, before June 30th. And hopefully everyone can just read this chart and understand what this actually means. But it is an opportunity to top up super. Now, I know that there are, I guess, different considerations around super now that there's going to be a new tax policy with balances over $3 million, but it's still a pretty good deal, even when you're paying those additional taxes. If you have more than $3 million, it's still likely lower than your marginal tax rate. So think about super, think about the tax advantages, because the one very important thing about investing is, of course, we want to minimize our taxes as much as possible. And of course, we want to minimize fees and transaction costs and everything else. But super is a great way to minimize your taxes. All right, this is probably where we'll spend most of the time this evening. And that's, of course, reviewing your portfolio. Now, the way that most people review their portfolio, and we'll go into some detail here, is generally they just look at the balance. They don't have a goal defined. They may look at how their portfolio has performed over the last year. Not a great way to do things. It's important to put a lot of structure around the way that you go through these reviews, because as investors, what we're also really not trying to do is be our own worst enemy. We don't want to go out there and suffer from what we call basically behavioral risk associated with investments. And that's a nice way of saying it. Real way to say that is doing something dumb. And doing something dumb generally is driven by emotion, so fear or greed. Oh my God, my account balance went down so much. That is a fear-based decision that comes out of that. Or, wow, my account balance did not go up as much as I thought it would be. And generally what this leads to is overtrading, chasing performance. So that's why we want to be really structured around these portfolio reviews. So one thing is, you're likely going to look at your account more than once a year, more than twice a year. But really sitting down and spending some time going through a portfolio review can be really effective in terms of making sure that you are trying to maximize those returns over the long term. We'll talk about what that means. We've talked about circumstances changing. But what we want to do is, of course, we want to build confidence that we are on track. Talk about kind of how you do it. This is really the point I made, this third bullet point about tinkering. So if you are looking at your portfolio all the time, which I assume most people are, but still what this can encourage is, of course, where you look at something, the more you're going to want to do something about it. So we do have an action bias as humans. We feel like we need to respond to everything that happens. And, that action bias is actually not great with investing, because it means that we overtrade and we tinker too much with our portfolios. And, I will say this is not something that is confined to individual investors. Professionals do this as well. You'll hear a bunch every time you hear a professional investor, they will talk about how they're long-term investors. Well, they're not. Some of them are, of course, but if you go and look at the stats, we look at the turnover in a lot of these funds and actively managed ETFs, they are really, really high. So you do, of course, have this tendency to tinker the more you look at it. And of course, if you think about a professional, what are they doing all day? Well, this is their job. So they're sitting there staring at this portfolio every day. There's a lot of pressure on them, of course, around short-term performance. So they tinker a lot. So do individual investors. And we'll talk about this in a second, but we want to go beyond this surface level review of performance, because solely focusing on performance leads to really bad outcomes, because you're making a decision off of that performance. And most investors make that decision without any context, not understanding why their portfolio or why a certain investment has performed poorly. And once again, that leads to very bad outcomes. So let's just go through a couple performance. I see there's some questions coming in. I'll get to those just in 1 second. All right. So let's talk about professional investors and individual investors. And one way that people look at performance to try to add some context is a benchmark. And a benchmark is basically just an index. And at the end of the day, really where we get this from, and we get this concept from as an individual investors, we get this from professionals. So if you are a fund manager, you will review performance against a benchmark. You'll do it because, number one, you are required to have a benchmark associated with your portfolio as a professional. And you also have generally limits. Now, while some investors can take a broader remit and invest in basically whatever they want, most professional investors are pretty narrowly defined by the rules of whatever strategy that they're trying to invest in. So, very simple example, you may be an Aussie, you may run an Aussie fund if you're a professional investor. So you can invest in shares in Australia. There may be more limits around that in terms of the size of the portfolio or the size of the companies that you can invest in. But generally, you will have this mandate. You'll have a benchmark associated with this mandate. The reason that, of course, professional investors are so focused on performance against the benchmark is because there's this notion, and it is true, there's this notion that, of course, if you're an active manager, you're going out there and picking individual shares to go into that. Well, your job is to beat the benchmark because I have a choice of accessing that benchmark, accessing that index very cheaply and very easily with a lot of these passive products. And the other big focus, or why professionals focus on this, of course, is because they know that short-term performance is a huge driver of whether they get additional funds to invest or funds get removed. And of course, they all work for businesses. What does a fund manager want? Wants as much money as possible because, of course, the fees they charge are based on how much money they're managing. So that is why there's also this huge focus, because even short-term performance differences against a benchmark will mean potentially very dramatic differences in the amount of money that comes in and comes out. So that being said, what should we do? Well, none of these things really actually impact us. So first of all, anything short-term related shouldn't impact us as long as we do have a long time horizon. We don't have a benchmark with which to associate our portfolio. Now, there's a couple different reasons for this. Number one is we don't have a mandate that we can only invest in a very narrow part of the market, like a fund manager would have. We can invest everywhere. And with low-cost ETFs, we can now have a variety of different countries and sectors and strategies that we can invest in. So it is more difficult to come up with a benchmark to associate against our portfolio. The other thing is a benchmark return does not have anything to do with our goals. That's why we want to find out the return that's needed to achieve our goals over the long term and look at that. So it's very difficult to say that your goal will be achieved if you get the same return. You might as the ASX 200. It's really, you're looking at something completely different. So it doesn't really apply to you to just look at your portfolio against a benchmark. If you have this longer term orientation, there are years that you would outperform a benchmark and years that you would underperform the benchmark. But what we're trying to look at is over the long term. And if you're simply comparing something to a benchmark, it means you might make changes if you have underperformed that benchmark. And that can lead to a lot of bad outcomes around tax specifically and transaction costs. The other thing that's really important is when we go out there and we get investment returns that are published in either the media, certainly when they are published by any of the investment companies that are putting that out there, when we're looking at index returns over the long term, remember that those returns are not what actually matters to you. What matters to you is the return that you get after taxes and fees and transaction costs, and the return that you get in excess of inflation. So very simply, what we are trying to do as investors is we are trying to take our money now, and we are trying to increase the purchasing power of that money over the long term. Well, we need to take inflation into account. So if we sit there and we look at this year when we have higher inflation, then all of a sudden a 5% return doesn't look very good in this particular year. And we want to look over long term, but this particular year, a 5% return is actually below inflation. So just remember that those returns and the things you see about benchmarks are not really necessarily what matters for us. We want to see those after-tax outcomes, after all fees, transaction costs, and certainly taking inflation into account. All right, so let's answer a couple questions. I think it's a good time to do that. So Lisa says, is it worth comparing performance of our own funds year on year? I mean, I think it is worthwhile looking at it, but it's only worthwhile looking at it with some context. So very simply, let's use an example. So if you were to sit there and look at your portfolio, let's look at sort of 2022 calendar year. So if you had some Aussie shares, some global shares, and some bonds, and you were sitting down there and looking at how your portfolio performed, well, a couple things are going to jump out at you. The bonds did not do well. So that's the first thing. We compare Aussie bonds versus Aussie shares. Aussie bonds had a lot worse of a year. Well, there are reasons for that, right? We did have significant increases in interest rates. If we don't think about some of those impacts and what interest rates do to bonds, we could very simply look at that performance and say, oh, well, I guess bonds are not a good investment. I'll just sell all of those and go buy shares. Well, maybe that's a good decision, or maybe it isn't a good decision. But at the same time, if you don't understand why something moved, then it's very, very hard to look at that. If you're looking at a fund that is being externally managed, it's really important to sit there and say, okay, why did this do well or not do well? Was it the stock picking of this fund manager? Was it just simply the asset allocation? What are the reasons for that investment doing well? And they'll generally put out literature talking about that, or you can use a website like ours and go in and look at that actual portfolio and try to figure out, okay, why has it moved in a certain way? So at least I do think it's worth comparing performance, but within context. So if you can't explain that performance, then really it's not a signaling mechanism for you to do anything. So yeah, I would just put that context around it. Okay, so we've got a question from Phil saying, if you switch super funds that incur any tax payable due to capital gains, is this the same when going from a fund to an SMSF? Yes. So that is a taxable event. So very simply, if you have Aussie Super as your industry fund that you've decided to invest in, and you want to start a self-managed super fund, well, what's going to happen? You're going to go to Aussie Super, they're going to sell everything, and then you will have cash that gets moved into your self-managed super fund, and then you go out and buy new stuff. That is a taxable event. Remember, capital gains are taxed within super now, as long as you are still working. And you're not in pension phase, but they are taxed. So that is a taxable event. Obviously, what that tax will be is based on that cost basis, which is generally pretty complicated to figure out because you're continually putting more and more contributions in. But that is a taxable event. So just remember that when you're switching super, and if you're switching super, and that same thing happens if you decide to go from one industry fund to another industry fund. Same thing could happen if you're just making changes in going from balanced to aggressive. So those are likely going to be taxable events. So it is something important to remember. And it is the consideration, we talk about this around self-managed super funds, that, there's a lot of focus. There's a lot of focus, obviously, on what asset level you need in your self-managed super fund to make sure that it is that the fees are cheaper doing that than maybe another fund. But just remember, bigger your balance gets, the longer you're in there, also the more likely you are going to pay taxes, and higher taxes when you do that. So something to think about. So Daniel's asking about end of financial year when you would rebalance or review to rebalance once more contributions come in. So we'll talk about rebalancing in a second. So I'll just save that. Daniel's saying I benchmark my returns again on likewise portfolio roughly. So as an example, my self-managed super fund is 80-20, benchmarked it, and APRA funds have a similar strategy. Don't make any substantial changes. There's no deviation. Yeah. So that's, it's a really good point that Daniel's making. And, when I talk about benchmarks, and maybe this is beyond what most people would do, well, it's very difficult to take a diversified portfolio and look at returns against a benchmark, a more narrowly focused benchmark, right? If I'm investing in Aussie shares and global shares, I don't know, it's not really fair for me to compare that against the ASX 200 or the S&P 500 or any index. But you can, of course, create your own personalized benchmark. So very easily sit there and look at your asset allocation, find an index that kind of corresponds with each one of those and the weightings you have, and you can calculate your own benchmark. I don't know how many people do that, but yeah. you can certainly do that. So Peter's saying, are super contributions included when calculating the return on investment each year? So if you're talking about performance and you're going and looking at performance from either, if you're using like an industry fund or a retail fund and they're giving you performance numbers, they will take those contributions into account. And same thing if you're using software like Sharesight to look at your portfolio. So the timing of those contributions will go into your overall performance numbers. So yeah, that is something that will be calculated by anyone who's doing kind of professional performance calculations. Yeah, so sorry, one point that I should make, saying in the chat, you mentioned 27,500 concessional contribution. Yes, as long as you're still working. So I was assuming on that previous slide that people were no longer working. I should have put that in there. So if you are still working after kind of the traditional retirement age, and you meet those ATO qualifications, and yes, you can continue to act like you were just working. See what else we have. Oh, poor Phil's going to make his partner watch this video. But you have a strong relationship for them to put up with this. All right, so let's see, what else do we have? Okay, so we've got the anonymous attendee saying, I'm in the pension phase now. If I move my balance to another fund or fund manager, then am I still liable for capital gains tax? No. So basically, when you are in the pension phase and you sort of set up your pension account, anything that's in that pension account, you don't pay taxes on. So that is a time where you can actually go in there and change your super. You can go in there and obviously sell investments. You will not pay capital gains once you are in that pension phase. So it is an important point. Will you pay capital gains tax if you take a lump sum when you retire? I assume that means no. So as long as you're in the pension phase, so number one, you qualify for the pension phase, you set up your pension, the money that you take out of your super won't be taxed. Any transactions that occur in your super in that phase will not be taxed. So you won't be taxed when you sell something. You won't be taxed when you actually pull it out of your super. So yeah, that is something important to remember. All right, let me keep going through and I'll get to a couple of the other questions. So goals. What's another reason why we want to set up goals? We want to set up goals because then we can track progress against goals rather than, of course, look at something like just comparing to a benchmark. And benchmarks are certainly interesting, but let's say the market goes down 25% and your portfolio goes down 20%. Well, that's great, right? Market's down 25, yours is down 20. You've outperformed by 5%, really good, but still not so good because your account went down 20%. So what we want to see is are we making progress towards goals? Now, obviously, your account going down 20% is not going to make any progress against your goal unless your goal is to lose all your money, and then you are getting closer to it. But that's really why we want to look at goals, why we want to calculate the return we need to achieve those goals, and then you can actually look at your return. So this is very simply from our goal setting feature on Morningstar Investor. And let me quickly go through what I've done. So I set up this goal in November 2020. And obviously, I just made this up, but I said I wanted $3 million. I've got $1.7 million. I'm not putting any more money in there. I've got 9 years to go. What return do I need? So I need 6.51%. So this is just from the website. Now, I've attached a portfolio to this. So set up a portfolio in Sharesight and attached it to this. What were my actual returns over this time period since November 24th, 2020? Well, the portfolio went up 7.68%. So now when I'm sitting there and I'm looking at returns that I've achieved, I have context. So this is a very good thing for me. It's a good thing because I've outperformed the return that I need in order to get to my goal. So, and here's my portfolio. We can see what happened to it. Okay, great. So I've grown faster. We can see sort of where it came from: capital gains, currency, dividends. See my total return. That's awesome. If I don't have this context, then what I'm sitting there looking at is I'm saying, okay, I can look at my performance number, 7.68%. Is that good? Is it bad? I don't really know. I can also look at my account balance, and a lot of people do that. And I could say, I don't know, I had $1.7 million, now I have $1.96 million. I don't know, maybe that's good, but I don't have any context around that. And so this actually adds context. And the other thing you can do is we have the original goals. We've got a little sub-tab, original goal, but then we have updated goals. So we've attached the portfolio, of course, to this goal. So it's doing two things in here. So when we're calculating that required rate of return, remember there are all those different inputs. How much I have, that's your portfolio value. How much I'm saving, that's really in the future. And then, of course, the time I have until my goal. So what this is doing is it's automatically recalculating that. And so automatically recalculating this required rate of return as you get closer to your goal. And then, of course, as your portfolio fluctuates in value. So I can see the impact of outperforming what I needed to get. My required rate of return went down. Now, this can be a signaling mechanism that, of course, you may want to change your portfolio. And you may want to change your portfolio because this return isn't in much. So maybe I can dial back the risk a little bit. Maybe I can change my goal. I can say, okay, well, I think I can beat 4.86. Maybe I want more than $3 million, right? I can adjust that goal. So we can see we used to have 9 years. Now we have 6.8 years. So we see that adjustment. Of course, we see the change in the portfolio. So goals allow you to actually track performance and provide some context. And it doesn't mean you wouldn't look at your performance against a benchmark, but what it does mean is then you take another look at your performance against where you're actually trying to get. All right, we're going to get to rebalancing, but I think we had another question. So Peter says, any comment on the U.S. share market rise based on just 10 NASDAQ companies, excluding from the U.S. market is flat for the past 6 months? Okay, a little bit of a different topic, but I'll quickly try to answer that for you, Peter, before we get into adjustments to our portfolio. So if people haven't been paying attention to this, the rally that we've had, particularly in the US market this year, has been very, very narrowly focused. So basically it's been driven by a very small amount of companies. So most companies, most share prices have not done well. And I think this is worrying a lot of people. And it's worrying a lot of people because the gains that have happened in the US market this year are not really looked at. What we want in general is we want a broad rally, right? We want everything going up. But what we've had is a couple of these very large technology companies that make up a large part of the index. We have those companies that have done really well and dragged the whole index up, while most companies have not. I think a lot of people are looking at that as a sign that the rally we've had year to date is not real. It doesn't have a lot of depth, and that, I've heard a fair amount of commentators talking about, hey, they expect another leg down, that, markets. And we had the chief investment officer of Australian Super at a conference we had for advisors, and that's very much his view. That bear markets typically have multiple drops associated with them, and we'll see another one. And I think he looked at all sorts of different factors, but I think there's not a lot of confidence coming from this very narrow rally. So a little bit of a different topic, but good question, Peter. All right, wow, I put a couple A's into approaching. Yes, it does need adjustments. I need adjustments, apparently. All right, so after you've gone through this, remember, what we want to do as investors is we want to put structure around everything we do. We want to put a framework around that to stop ourselves from doing dumb things. So after we've gone through that whole process, we've looked at our goals, we've looked at if we want to save more money, potentially get more money into super. We've looked at the performance of our portfolio, but we've done it with context, why different things have performed different ways, associating with our goals. The last thing is, do we want to make adjustments? Now, why is now a good time to make adjustments? Well, or potentially not a good time, but if we make those adjustments, obviously right now, that will impact this tax year. We wait till July, it'll impact next tax year, and those could have consequences. That's why it's a good time to go and sit and look at your portfolio. So one thing that we might want to do is rebalancing. So very quickly, what is rebalancing? And I'll get back into that specific question we have. So when we build a portfolio, as I talked about, what we want to do is we want to build a portfolio that can help us achieve our goals. And that there are two different components to it. So the first component is, of course, returns. So if we need a 7% return a year to achieve our goal, well, we really shouldn't have a portfolio that's 90% in cash and bonds, right? You're just not going to make it. So we want to align our asset allocation with the return we need to get. The other side of that thing is, of course, as we're approaching our goal, then that short-term volatility or how much your portfolio bounces around could impact our ability to achieve our goal. So potentially, we have a shorter time horizons. We want to change our asset allocation, get more defensive, where there's less volatility. The problem, of course, is that we may come up with the asset allocation we need, whatever we need based on our unique circumstances, is, of course, every day that securities markets are open, prices are going to change. And we are going to have relative outperformance of some asset classes, relative underperformance of other asset classes, and that asset allocation is going to change. So if we never do anything about that, all of a sudden we could have confidently gone through our entire plan, done all the steps that we recommend, you've set your goal, calculated your required rate of return, you figured out the asset allocation that you think will give you a good chance at getting that return. And then you never look at your portfolio again, thinking, I've done it all right. And one day you look at it and find that 99% of your portfolio is in shares when you're trying to have 60%. Because they've relatively outperformed. So that's why we want to periodically rebalance. Make sure that our portfolio is still aligned with what we're trying to accomplish as an investor. But remember, rebalancing has downsides, which we've talked about. Taxes. We don't like paying taxes. We don't like paying taxes because they take away from our returns. Transaction costs, rebalancing involves buying and selling things generally. So they're transaction costs. So we don't want to do it very frequently. And, you could rebalance at any time over the year. We don't want to do it frequently, but we can set a periodic time. It doesn't have to be as part of the financial year. I think the reason why this makes a lot of sense because for tax reasons, a lot of investors, and because of things like contributions to super and changing tax years and all of that, a lot of investors look at their portfolio and their finances now. So it sort of logically makes sense that you would want to rebalance now as well, if that's something you do. But yeah, in theory, you can rebalance anytime, but we don't want to do it too much. And there's really two general approaches that people take. So one is, as I said, a periodic time. On an annual basis, I'll look at my portfolio and decide if I should rebalance. And so this is when you're doing that, it's a good time. Other thing is set a tolerance level. So if we want 60% of our portfolio in shares, well, we're not just going to rebalance if all of a sudden it becomes 61%, because rebalancing has downsides. Said we can set a tolerance. I won't rebalance unless this gets out of whack by more than 5% or 10%, whatever that is. And generally, I would encourage you to also make sure that you're not doing this every time it gets outside there. Periodic review, but look at it within the lens of those tolerances. So really combining those two things. So how do you rebalance? Look at me. I'm just adding all sorts of different letters to things, or just repeating letters. Anyway, sorry about that. The other thing that we always talk about with rebalancing is rebalancing, and I think there's a lot of confusion out there, and I think by professionals and individuals, rebalancing is done to align your portfolio with what you're trying to achieve and the returns that you need to achieve. So it's really looking at asset allocation on that asset class level. So what we're talking about there with an asset class is shares, bonds, things like that. Diversification, or the individual holdings in your portfolio. So I may allocate 20% of my portfolio to Aussie shares, and I may go out there because I love picking individual companies, and I may have 20, 30 positions, right? So overall, you can have all sorts of positions, and we're generally looking at either narrow ETFs, so ETFs that are not following a broad index, or individual shares that we have in there. The reason I have more than one share in my portfolio is diversification, right? I'm spreading out my risk. So I'm reducing my security-specific risk. If something goes wrong with the one company I put my entire portfolio into, I'm spreading that out by having more holdings. So these are two very different things. But it's not a bad idea to also look at how diversified your portfolio is when you're doing this review. And really, we've got some stats in here. And, it's interesting with that question about the NASDAQ and a very narrow focus, a very narrow amount of tech shares. In general, if we go back and look at some of these studies, it's been a small amount of shares that have really outperformed the market over the long term and dragged it up. So something to think about. It is hard to pick these winners. But when we look at diversification, we want to, once again, put that within a goal context and sit there and say, okay, well, even if I'm really confident with this company, just remember anything can happen. Have I put too much of my portfolio into that company where if it was to become worthless or it was to lose a lot of value, would that eliminate my possibility of achieving my goal? And that's what we're talking about, that security-specific risk. So it's a good time to think about that and making sure that positions have not grown too large. Now, remember, if this is a broad ETF, you have an ETF that's covering the S&P 500, those positions, of course, can get a lot larger than if you're going out there and buying individual companies, because those are naturally diversified. A couple tips for rebalancing. Think of ways, try to come up with ways that you can rebalance without actually selling anything. Because once again, we don't want to sell things if we don't have to. And a couple different ways we can do that is, number one, the role that cash can play. So I know that cash gets a bad name, and cash over the long term has barely outperformed inflation. It's certainly underperforming inflation now, but having some cash in your portfolio enables some flexibility. It helps with rebalancing. That basically I don't have to sell anything if I have a little bit of cash. So I see that my equities are a little lower than I want. I just put more money into the equities rather than selling bonds, buying shares. So cash can play a role. Think about the other ways that cash goes into your account, additional contributions. So be very cognizant of where that money goes in, rebalance through those contributions rather than having to sell anything. Those are all important as well. And then we have the certainly making sure you have that tolerance that we talked about before. All right, last slide, then we'll get into questions. The other reason why it's good to look at our portfolio before the end of financial years, of course, there are ways to minimize your taxes. So tax loss selling basically means that at the end of the day, if you have capital gains that have been generated, you can offset those with losses. So now is a good time to do that because, of course, as soon as the calendar flicks over into the next year, well, you've lost that opportunity. You can obviously do it in the future, but you've lost that opportunity in terms of this tax year. So end of financial year is a good time to look at that. Remember, a little bit of a warning on here is that just be very cognizant of wash sales. So what a wash sale is I sit there and I bought a share that's gone down in price, and so I just sell it at the end of June, but I do like the share, and then I just buy it back in July. And I think this is great. I sold this thing for a loss. I'll use that loss to offset capital gains, but then I'll just buy the share couple weeks later, that is a wash sale. The ATO does not like wash sales. It's illegal. So just be very careful about that. But if you're legitimately selling something, then now is a good time to sell it if you have some capital gains to offset. All right. So got some more questions coming through. So we'll just get into that. I think someone was telling me to start drinking, but unfortunately I have to wait until the webinar is over. Although if anyone attended the COVID webinars, I used to drink during those. Look at Daniel. Daniel is into the goals. So we've got, sorry, I'm looking at, okay, here we go. If I'm in pension phase and I sell shares that are in my own name, will capital gains be applicable? My personal income theoretically will be low because taking a pension is zero tax, but how would that work? Yeah, so I think what you are asking is if you have investments outside of super during the pension phase, what happens if you have capital gains there? Well, what happens is that's a capital gain, right? So even if you're in pension phase, if you are in the money in super in pension phase, no capital gains, you will still pay capital gains. Now, the question, of course, is what is your marginal tax rate, which you put into this question. So depending upon the income you receive, so remember, income can come in from dividends and interest and anything that's sitting outside of super that's generating income, rental, property, whatever. Any of that income that you receive counts as income, but it depends how much you make and what your marginal tax rate is. But yes, you will owe taxes if you sell shares that are outside of super, even if you're in pension phase. But I think as you're pointing out that, if you are in a low marginal tax rate, potentially you're not paying that much. So Phil says, perhaps take a medicinal amount of Shiraz before doing the webinar slide deck. My fingers stuttering on the keyboard. Yeah, it's just the shakes, right, from last night. But yeah, I think a Shiraz would be very nice. So Jan says selling equals capital gains, which hurts more than cash sitting there, personally speaking. I mean, I agree that, you do very much need to realize the hit that you are taking in capital gains based on your marginal tax rate. So yeah, we want to minimize that. Peter says, go back and show a slide. So I can do that. Plus, it's much better than having me blown up on the screen, I assume, as well. There you go. There's a slide. I think Peter just wanted to read through some of those stats. So we have the question, are you better to sell shares that have not done well and offset against capital gains? Obviously, it depends what happens with that share in the future. But yes, offsetting capital gains is a good way to minimize your taxes. So Daniel's saying the same thing. Depends if they will do better. Is it still a wash sale if you buy it and if you sell it and buy it back in the same year? Yes, it is. So what you need to think about with the wash sale. So technically, right, if I sell a share and I sell it for a loss, I have that offset. Even if I go buy that, it doesn't do anything to that offset. So that would still be a wash sale. Was reading ATO capital gains rules, came to the conclusion, I would say, do not claim losses against long-term capital gain. Losing benefits, better pay taxes, use only against short-term capital gains. So basically, the comment there is really looking at, of course, you get a discount for long-term capital gains, right? You get a 50% discount on those capital gains if you've held a share or any other investment for longer than a year. So I think, the comment's just being smart about what you're actually offsetting. See what else we have. If I'm in pension phase and I sell shares that are my own name, will capital gains be applicable? My personal income theoretically would be low. Yeah, so that was another question, Ann, that we had in the chat that I did answer. But yes, capital gains will be applicable if the shares are not within your super fund. Okay, so Troy says any general guide to the max amount percentage to not go over for a single share in super. All right, so it's a really good question. So the answer I'm going to come up with is it really depends, but we will certainly go through some of those things. I won't just say it depends. That's not great. So it depends. Number one, what's a factor? Well, the factor is how close you are to retirement. So if you are younger and you have a larger position as a percentage of your portfolio, maybe that's something that actually is recoverable from. Now, remember, you are giving up a lifetime of compounding on that. But if you're approaching retirement and you have a large position in your portfolio, yeah, that could be a problem. There are two schools of thought in terms of diversification into individual shares. So there's certainly this school of thought that I'm not going to overly diversify because at some point I'm just buying bad ideas. Why do I want to go invest money in my 100th best idea? I want to concentrate that on my top ideas. Well, number one, a lot of people suffer from overconfidence with investing. I'd be careful you're not falling into that boat. Yeah, I guess that's the really big one. Number two, remember that even the best analysts, things happen to companies that are unexpected. And COVID's a perfect example. And the example I always use is there are a lot of people who were probably invested in Virgin and thought, they've got some debt, not that big of a deal. Like, here's all the reasons why air travel will continue to increase. And then COVID happened. Obviously, there's no travel. They went out of business. So just remember, these very unexpected events can happen. The other thing I would just say is volatility impacts you more as you're approaching retirement. So even if something does not go to zero, that would be, that's not necessarily a good thing because something really bad happening with one share can, of course, increase the volatility of your portfolio. So I personally don't put more than 5% into any single share holding into my portfolio. Feels like a number that's okay for me. Now, a lot of people that I talk to will say that that's probably too high. One of the reasons that I do that is because I do hold more cash, which is a little bit of an offset for that. But it's just kind of what I'm comfortable with. Now, it doesn't mean that there are 20 shares in my portfolio. I will just not let a position get higher than 5%. Okay, so Dan just asked that question. It does not mean there's 20 shares. All it's meaning is, and I don't aim, if I was investing in something new, if I put money into my portfolio, I don't aim to get a position up to 5%. All I am saying is that that is the absolute limit that I would let something get up to. So I have a lot more holdings than 20. And I don't just invest in individual shares. So I do invest in ETFs. And I'm only talking about individual shares here. Remember, those broad ETFs certainly would be a lot larger positions, right? Because they are following a broad index. I can buy an ETF that owns every share in the world. I wouldn't put that 5% limit, but I would just put that on an individual company. And the other thing I would say is, think about some of these indexes and what makes up those indexes, right? You go and buy the ASX 200, that means that more than 10% of your portfolio is in BHP. So something to consider as well. But yeah, I think I just go through like, what are the impacts to my goals if something went to zero? If you have 10% of your portfolio in a certain share, for a lot of people, that would impact their ability to achieve their goals. All right, I've got a couple questions. Oh, very nice comment from Peter. Thank you for that. Kind of answered that. Okay, so Daniel says, what do you let your cash percentage get to? Yeah, I mean, I can answer that. So, what I would say is, and I've been kind of clear about this on the podcast and everything else, in general, sort of my asset allocation that I'm trying to achieve, and once again, this is just me based on my goals, is 90% growth assets, 10% defensive. I choose to hold that defensive in cash. And there's several reasons that I'm happy to go into later, but we are at time. I hold 10% in cash. I've let that cash build up over the last couple of years because I just thought valuations were really high. So I have a lot more cash right now, but that was kind of a tactical decision and just looking for hopefully some bargains. That is timing the market, and I would tell most people not to do that. But do as I say, not as I do. But yeah, I've just had some cash build up. And a lot of that is because I was on track to achieve my goals. That required rate of return got lower and lower and lower. So I felt that in the short term, I could do that. Let's see. I mean, 5% of my invested portfolio. So to that question, so I don't count, and I think a couple of people, I do not count my emergency fund as part of my portfolio. I will count cash that I have put into an investment account and is not invested. But my emergency fund, which is sitting in a bank, I just exclude that. I kind of say that that's the ticket to invest. That's just going to sit there in case I get fired for drinking Shiraz during a webinar, for example. Yeah, so Daniel's saying, I know someone that owns a bunch of STW and then went and bought a heap of BHP and Telstra. Yeah, so I mean, that's one of the problems with sort of a lot of markets, but particularly the Australian markets. That is, yeah, it's one of the problems and that's why look at your asset allocation. And we have a great tool called Portfolio X-Ray at Morningstar that looks through those funds and ETFs. But that's where you can get these huge exposures, right? You put a bunch of money into an ASX 200 index fund, 10% of BHP, then you go buy BHP, you buy a couple banks. Well, you're going to have a lot of exposure. I think I've answered all the question. Oh, no. Lots of messages. Can we come drink Shiraz with you? Yeah, it's better than me drinking alone in the dark. All right, so I think I've got everyone's question. Anyway, thank you guys very much. Really, really appreciate you spending Thursday evening with me. And I hope everyone has a great night. And yeah, I'll be back on Tuesday to talk about something else. I don't know, but I'll figure it out before then. But anyway, thank you guys.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.